And then we're going to do the Chapter 1 and 2 CPA question review. I'll send that out right before we go on break. I'll send that out. And you guys can get extra credit points for that. And if you get the for the correct answers, if you get 5 correct, you'll get +2 added onto the test. Six correct. No, I'm sorry, 7 correct. +3. 9 correct. +4. And the class gets all 10 correct. +5. And I'll tell you how we're going to do this. We're going to do it in a poll. So anyway, so extra credit points will be added on. So this will be just before we go on break. We're going to finish up the classical sampling. And what do I do here? After class, the Chapter 1 and 2 exam will be emailed to you. You'll have a little more than a week to do it. It's due a week from this Friday. So what is it? 9 days? So anyway, so the Chapter 1 and 2 exam will be emailed after class. Okay, any questions? Okay, some of you will, I got a couple emails back. I think you guys can get into the ebook now, so hopefully that's all resolved. If not, let me know. If you still can't get the ebook through the Laker bundle, let me know. Okay, let's start up. Let's finish up Chapter 1 and 2 handout. Okay, this is on page. My page numbering might be different than yours because but somewhere around page 11. Okay, what type of misstatements do auditors look for? Oops. Okay, auditors only look for material misstatements. And that's no matter what they're doing. Man, we talked about this before, but material misstatements are the only thing they're looking for. They're not looking for all misstatements. They're not looking for make sure everything's down to the penny. They're only looking for material misstatements. Again, this is one of those things that the public kind of has a different idea than what actually happens. So they're only looking for material misstatements. So those things that would be material to the average investor. Now that's a judgment call, but that's basically what we are looking for. And it doesn't matter what area we're talking about. It could be a misstatement due to legal problems. It could be a misstatement due to whatever. We're only looking for those things that are material. Okay. What is the difference between an error and fraud? What is the
Error
difference?
would not be made on purpose, and fraud will be made on purpose.
Exactly. An error is unintentional. It's made by accident. It's not made on purpose. Fraud is. So we're only looking. So basically, we're looking that it was. If you, an error is going to be an unintentional misstatement. Whereas a fraud is an intentional misstatement. It was made to deceive. So this is an element of deception. Mistakes are not illegal. Fraud is. Fraud is an illegal act. So, and by the way, when it comes to prosecuting people for fraud, that's always that's the biggest sticking point, is whether it was unintentional or intentional. And it's hard to prove, and sometimes it's hard to prove whether it was intentional or unintentional. How do you say, well, how do you prove that it was intentional? One of the things they look for to see if it was intentional is, did somebody try to cover it up? If somebody tried to cover it up, then they knew about it. They knew that it was wrong and they were trying to cover it up. So anytime someone tries to cover it up, that's a pretty good evidence that there was an intent to fraud. But unintentional, somebody making a mistake, that's not fraud. It does happen, but it's not fraud. Okay. Type 1 fraud. Type 1 fraud. Oops. Okay, type 1 fraud is when an intentional misstatement appears on the cooking the books. So this is a second here. So cooking the books, making the company look better usually than it really is. Type 2 fraud is the wording of it's kind of funny. This is misappropriation of by employees. This is theft. Let me change that. Employee theft. I like the term misappropriation of assets, but that's taking it. Oh, actually, let's see, type 2 fraud is. I gotta clean it up again. Okay. So we have type 1 fraud is cooking the books, an intentional misstatement of the financial statements. Type 2 fraud is misappropriation of assets. I love the word misappropriation. It's such a nicer word than theft of assets by employees. By the way, which fraud are the auditors more concerned about? Type 1 or type 2?
Type 1?
Yep. Yeah, auditors are really worried about type 1, the statement of the financial statements. That's what you sign that report, that report we talked about last time, that it says that we're reasonable assurance about whether the financial statements are free of material misstatement. That's where, so we're talking about the financial statements, and we're not, if the financial statements aren't misstated, we're fine, even if there is some fraud evident. But So we actually sign off on the financial statements that, reasonable assurance about whether they're free of material misstatement. Okay, so type 1 fraud, what we're more concerned about. Type 2 fraud is not that we don't look into it, but it is only if it's material. So if someone steals, $100 out of petty cash, it's not a good thing, but as far as the audit's concerned, petty cash is by definition immaterial. We're not going to report on that. If we ran across it, we would let management know about it, but we're not going to be looking for it. So we're only looking for those things that are material. And then when you get into the larger companies, and you talk about the multi-billion-dollar companies, it's really hard for one person to commit enough of a fraud that it would cause a financial statement to be misstated. Someone could be stealing $100,000 a week from Walmart, and it would be absolutely immaterial. $5 million a year, whatever, immaterial. So, it would take a lot of theft to make it material for something like Walmart or any of the larger companies that are multi-billion-dollar companies. It's almost impossible for individuals to actually create that stuff. So we are focused more on the financial statements and what they are. Now, but that brings up a good point, though, in that, we're always only looking for things that are material. Okay, so when an employee, even if they are committing a fraud and stealing or whatever, if it's not material, it's not really our problem, and we're not going to be looking for it. And again, we're always looking for those things that are material, not things that are immaterial. So, if we find them, we run across them, we usually tell someone to manage, oh, by the way, there's, $80,000 missing out of cash. It's not material. We're not going to do anything with it, but you should probably know. We also don't investigate those things. We run into fraud. We generally don't. It's not up to us to investigate that. What we do is we tell upper management about it, and we'll talk about this in a second. You tell upper management about it, and they should act on it and figure out who did it. And that we don't start our own investigation while we're in the middle of an audit to figure out, who to blame and all that kind of stuff. Let me go back to the. Okay. Compliance with laws, illegal acts. Now, again, we're only looking for those things that are material. Okay, direct effect. Oops. Let me put it. Illegal acts have a direct impact on the financial statements. Important to the auditors. Let me clean this up a little bit. And I'll give you an example. Okay, so illegal acts that are, before I. Example, tax evasion. Tax evasion, because that will have a direct impact on our tax expense account. That'd probably be a better way for me to. Okay. So if their illegal act is tax evasion, well, that has a direct impact on the tax expense account. Well, now we're more interested in this tax evasion. It's an illegal act, and there's a direct effect on the tax expense. So those things that have a direct impact are more important to us as auditors. Other laws, indirect impact. Um, illegal acts that have an indirect impact. Oh, what do I mean by that? Are of less importance. Example, environmental protection fines. Oops. This is a illegal acts. Wait a minute. That's right. Okay, so environmental protection illegal acts. So let's say you have something that their client, you find the client is doing something, they're doing something illegal when it comes to the environment. Maybe they're not disposing of something properly or something like that. So environmental protection. Now you might say, well, wait a minute, couldn't they get fines? Yeah, they can sometimes. Sometimes they get fines. Sometimes the EPA just says knock it off. It's hard to tell what because it's not direct. It isn't like we didn't report this income and there's X amount of dollars that are going to show up on the financial statements. You don't know what it's going to be. Again, it could be a fine. It could be stop doing this. Whatever it is. You don't know what the impact is. So you're less we're less in tune to those things because first of all it's unknown, and a lot of times it may not be any financial impact at all, even though it is an illegal act, or it might be something trivial, not trivial, immaterial. Someone has a zoning problem or something like that they have may have a fine of $1,000 or something. You don't really do much with that. Okay, responsibility for detecting illegal acts, same as anything else. We only look for material illegal acts. We do not look for all illegal acts, only material ones. And if they're not material, we don't look for them. Okay. Responsibility for reporting the illegal act. So if the question comes about, what happens if you find an illegal act? What do you do with it? When illegal acts go over the auditors, it should be reported. to upper management and board of directors if they have an audit committee, the audit committee. Audit committee is part of the board of directors. So if they don't have an audit committee, report to the entire board of directors. Okay. Important note. Auditors generally do not investigate the illegal act. So you find an illegal act, you don't do the investigation. Investigating illegal acts is a separate activity by itself. You're reporting to the board of directors and the upper management and the audit committee. If it involves upper management, you're not going to include them. You're just going to go to the board of directors or audit committee. But the auditors generally are not the ones to do it. So some say if you read a CPA question, it'll say, okay, we find the illegal act. You perform an entire audit of the to find out the illegal act, who did it, and all this kind of stuff. You give it to upper management if they're not involved, board of directors, audit committee. You report it up to them, and they should act on it. So you don't actually do that, that investigation. I'm going to put one more thing in here that's actually can be very important. Another note. Wow, look at all these notes. The editor should not. The editor should not accuse anyone of an illegal act that has not been proven in a criminal court. Okay. This can lead to a civil lawsuit. For slander. Okay. So you find that a clerk has been stealing from your client. A clerk is working in there. You find out that that clerk is stealing. You give all the information to the client. The client is required to look into that and to figure out what's going on. You do not say that that clerk is stealing funds or is committing a fraud or anything like that. If they have not been convicted in a criminal court, you're accusing them of a crime that they have not been convicted of. They can sue you for that. This way you can't say, oh, this guy, this person's a murderer or something like that. And if they haven't been proven in a court of law, you can't do that. Well, I get you can do it, but you get sued. And you'll see sometimes and say, well, this company caught this guy committing embezzling money, and he turned around and sued the company and won. Like, yeah, they said he was embezzling, and he was never convicted of embezzling. Absolutely he won. Until it's proven in the court of law, in the criminal court. Another thing you say, well, I know when that person sues me, I'll prove that they stole the money. There's a difference between a civil court and a criminal court. Civil court is you're suing for dollars. That's what slander is. No one's going to jail in a civil trial. Okay. You cannot get a criminal verdict in a civil lawsuit, in a civil file. So you can't. There's no way you can get a criminal in a civil lawsuit. There's no way you can get a criminal designation on that. So the easiest thing is just not to do it. Just state the facts. $105,000 was missing from whatever. Give it to the client. Let them investigate it. Let them, if they want to take it to the police, they can take it to the police and get a criminal. If the police will take it, if an attorney, the district attorney, whatever, will take it, it will get possibly a criminal conviction. But until that happens, you do not accuse anybody of a crime. Just for your own, they can sue you, and if you actually did that, they will prevail. So don't accuse anybody of a crime they have not committed. And generally, I've actually written up where people were let go. You just write out the facts. Here's the facts, for this person. I never put their name in the report or anything else. And say here's what was found on this expense report or whatever it was. So don't ever accuse somebody of a crime that they has not been proven in a criminal court. And you cannot prove you can't get a criminal conviction in a civil court. Civil lawsuits are only for dollar amounts. Okay. Types of audit reports. Okay, the first one is the best one. Is the unmodified report. It has different names. Sometimes called the standard report, clean report, unqualified report. So the best is, and this is when we believe that it is, do something here. Real assurance that the financial statements are free of material misstatements. In other words, we don't think that the financial statements are materially misstated. They are fairly presented. And not misleading. So that's the best report you can get is an unmodified report. Sometimes called the standard report, clean report. Unqualified, this is what the they call it for the for issuers. sort of publicly traded companies, they'll call it an unqualified report. What I mean by unqualified, I know the term unqualified seems like a bad term, but what they mean by unqualified is that, everything's okay and I'm not going to put any qualifications on it. I'm not going to, for instance, here's my phone, the phone's great, except that it doesn't answer phone calls or whatever it is, that's a qualification. So an unqualified report means, here's a report and we're not going to tell you anything else. You can rely on it. It is, it is not materially misstated and so on. So unqualified, well, that sounds like a funny term. It actually just means that we're not going to add anything else to it. And so this is the best report to get. Most companies get these reports, and I'll tell you why in a minute, but these are the best. Okay. The next best. Second best. This is when this is a qualified report, sometimes called a modified qualified, and sometimes called an except for report. So I'll talk about in a second. Okay. Qualified report. Oh, wait, I didn't put a parentheses around those. Okay. Qualified report. Qualified report means that there is a material misstatement exists. But it is not pervasive. In other words, the financial statements as a whole can be relied upon. Usually one or two accounts are impacted. Okay, so let me, okay, so not pervasive. It's not throughout the entire financial statements. It's only one or two accounts. And the financial statements as a whole can be relied upon. Or that they are, as a whole, are fairly presented in a way. Okay. This is commonly called an except for. Kind of a funny reason. So a qualified report. The reason why except for is, they call it an except for, is because it'll say, hey, everything's fine, except for, and then it tells the bad stuff. So oftentimes they're called an except for opinion is everything's okay except for, and then they tell you whatever's bad. It's not so bad the financial statements are not fairly presented that they can't be relied upon. However, there is a material misstatement in there, or a question about a material account in there. And again, this is usually when it's isolated in one account, or that it's not throughout the entire financial statements. it doesn't have anything to do with income and revenue and cash and all this kind of stuff. That it's usually there's something that's material, but it is not throughout the entire financial statement. So these are commonly called an except for, and that is the qualification. The qualification is, everything's okay. Here comes a qualification, except for, now it's a qualified report. Okay. So you get the unmodified, qualified, the worst opinion. I'm gonna make it in capitals, big angry capitals. The worst opinion. Hold an adverse. Oops. Forgot how to type here. Okay, the worst opinion is an adverse opinion. I can report it here. Okay, adverse report. This is when material misstatements, could be more than one, exist and are pervasive throughout, has an R in it, in case you're wondering, throughout the financial statements. These are also called not GAAP. They don't follow the rules. They cannot be relied upon. So these are the worst. This is the worst one you can get. Okay. Now I want to talk about something about the kind of the similarity between the qualified report and the adverse. Okay. For this one, oops, forgot an else. The misstatement is known. What I mean by that is we'll say, okay, these are misstated by whatever. So we give a dollar amount. And we'll put it right in the report. Same thing for the adverse opinion. Whatever it is. So for B and C, we know how much it's misstated by. And we'll put it right in the report. So if it's a qualified opinion or an adverse opinion, when we find that it's something misstated by whatever amount, it goes right in the report. This is misstated by $50,000 or whatever it is. So think about this if you're talking with a client. Generally speaking, you don't want to give them a qualified report or an adverse report. What you want them to do is make the financial statements, not materially misstated. So one of the things about these two reports is you tell the client, look, either you change this or you're getting a qualified report or you're getting an adverse report. And it's going to have, you're not going to hide this from anybody. It's going to be right in the report. what these are misstated by. It doesn't do the client any good not to correct the financial statements. And you want them to. It isn't like you surprise them at the end and give them an adverse opinion. You talk to them and say, look, you got these sales here that, these aren't really sales. You got to take those out or else you're going to get an adverse opinion. If I give you an adverse opinion, it's going to go right in the report, and anyone who reads that report will know that you're basically putting out fraudulent financial statements. It's going to be a double whammy. Not only they know that your financial statements are misstated and how much they are, but they're also it looks like you're trying to deceive people. So there is no good reason why a company would get there actually is a couple situations where you could possibly get it qualified, but certainly an adverse opinion, there's no reason why you'd ever have one of those, because it's going to be in the report anyways. You might as well make the changes in the financial statements and get a clean report is much better than getting an adverse opinion that tells how much they're misstated anyways. Now, do adverse opinions happen? Yeah. You get people pounding on tables saying, you got to change this, and then someone else on your side pounding saying, I'm not going to change it, and then they get an adverse opinion. And again, it's the worst thing you can do, because it also reflects on the management of the company that, hey, they're not being honest about reporting. So there really isn't a good, qualified adverse opinions. They're very rare for that reason. And even if the client doesn't agree with it, they probably will make the changes just so they don't get an adverse opinion or even a qualified opinion. So those two, we know the dollar amounts. We put it right in there. We put it right in. Here's the dollar amount. There's $4 million of assets here that don't exist. So it doesn't do any good to get a qualified adverse opinion. So these are really pretty rare. Okay, the last one is kind of wacky. And this one is what I'll say is unknown. And this is a disclaimer of an opinion. That is called a disclaimer. And this is no opinion. Okay, so when does this come about? The auditors are unable, enough evidence to form an opinion. The misstatement, if any, is unknown. So a disclaimer is that auditors are unable to gather enough evidence to form an opinion. And this can come about a few different ways. It could be that the client's records are just not adequate enough to actually do an audit. Now, hopefully, that you'll spot that early on if you can't give an opinion. But if their records are not good enough, I met a guy that was doing an audit one time. This guy called him in to do this audit. He was a construction kind of contractor guy, and virtually all his transactions were done in cash, which is really hard to do. You're talking about thousands of dollars. and most of them were done in cash. And it was just the way the guy operated. It wasn't, he said he didn't think the guy was actually doing anything wrong, but as far as an audit is concerned, if everything's done in cash, you have no paper trail. Someone comes and drops off cement and you hand them cash. There's no check coming back from the bank. There's no invoice. There's no, there's nothing to do, to compare this to. And then, and the guy was actually, fairly successful, but again, he didn't have a paper trail. So that's one of the reasons it can be. It can come about, suppose they have a computerized system, and what happened? If someone came in and broke in and stole all the computers with all our information. Oh, okay. But you have backups, right? Yeah, we have backups. Where are they? They're in the safe. Oh, where's the safe? Well, they took the safe too. You can't get the information. It can also come about if a client doesn't allow you to get the information. One of the things we have to do is contact the client's lawyers about any lawsuits and that might impact the financial statements. And if the client says, "I'm not going to let you talk to my lawyer," if you can't get the information you need, you can't get the information you need, and they get a disclaimer. And a disclaimer, there's no dollar amounts. If they do put dollar amounts, they'll say, we don't know about these dollar amounts. So a disclaimer is really no opinion, and it doesn't do anyone any good. It's like handing them nothing. A disclaimer is like nothing. Here's nothing, and here's my bill. So a disclaimer is also not desired, but it's unknown. It might be misstated, it might not be. You just don't know. Okay. Let's see how this all plays out. All right. Number 8, the auditors were unable to verify significant investments made by their client. Which report would be appropriate for this scenario? Anyone?
For 8?
If they're unable to verify these investments, they can't get the information on them. So yeah, disclaimer. A disclaimer of opinion. We'll talk about a little later, maybe, that it is possibly going to modified. We'll talk about it in a minute. The auditors determined that cash, inventory, and revenues. Yep, you're right. There you go. The auditors determined that cash, inventory, and revenues were all materially misstated. Which report would be appropriate? Which one do you think?
Is it B?
It could be B. Because this is actually this is the balance sheet stuff, and this is an income statement. Most likely be C. Did you say C? I'm sorry. But it's possible as B. It depends on how pervasive it is, but it is possible that it could be B. But because it's in several accounts, and one of them being cash, and then also revenues, it probably end up with an adverse on that one. It's a judgment call, though. It depends on I didn't give you the dollar amounts or anything like that. So, all right, how about number 10? These are all immaterially misstated.
Would that be B?
Nope, probably not. They're immaterially misstated. So they're misstated, but not by a lot. Not enough to make a difference to anyone.
A?
Yep. Yeah, that'd probably be A. So we don't say the financial statements are not misstated. We simply say they're not materially misstated. So if they're immaterially misstated, which quite honestly most statements are, they are they get a unmodified or unqualified report. Number 11. This one's a little bit tricky. The auditors were unable to verify a material amount of off-site inventory on a client's books. None of the other accounts were materially misstated. The auditor would report the appropriate. Oh, which audit report would be appropriate for this one? So it's a material amount. Oops.
Would this one be B?
Yeah, most likely be B.
That's like the except for it.
Exactly. You say, look, everything's okay except for this offsite inventory that we were unable to verify. If it was significant enough, you might give them a disclaimer, but usually, that's going to be a modified report, even though it is, it's unknown because it's concentrated on one account, and even if that account was misstated, it would probably end up being a modified report. If it was misstated completely, it'd probably end up being a modified report anyways. So in this case, even though you can't verify it, even if you took the worst case scenario, you'd probably end up with a modified. Okay, why are qualified and adverse opinions rare?
Right?
Could be, but you know what? I can tell you one more thing.
Is it C?
Um,
I'm sorry.
no. Qualified and adverse opinions are because they include the misstatements. They'll actually include the misstatements in the amounts. So qualified and adverse opinions. Here. Let me show you. Back up here. Because these are known and they're put right in the report itself, the misstatement is actually shown in the audit report. They're not going to hide, they're not going to be able to hide it. So if you find a misstatement that it's fairly rare that they will not go ahead and change it. There is something to be said about both of these, but the best answer. One thing I want to tell you, the CPA exam. This is actually in the rules that to taking the CPA exam itself. They tell you to which is the best answer for all of them. You're looking for the best answer, not necessarily the only correct one, and that's so you might have two answers that are actually correct on the CPA exam, but they'll ask you which is the best answer for them. So it is again, it's going to be a judgment call a lot of times. So anyway, this is the the qualified adverse opinions include the misstatements. It's one reason why these are very rare. So if you are tempted to give somebody one of these opinions and you talk to them, they'll probably make the changes. Even if they don't agree with it, they most likely will make the changes. Okay, next thing we're going to do, I'm going to send this out before we go on break. When we come back from break, you can start filling these in. But the Chapter 1 and 2 CPA review questions. So, before let me just go ahead and send that out. So these are questions. Most of these come right off the CPA. We're in actually CPA exams. And I will. Okay, so here's what I'm going to do in the Zoom meeting. So in the Zoom meeting, I'm going to send out a poll. My polls. Oh, poll. More. I don't think they have the polls. Okay. So hopefully a poll will show up on your screen. So there's going to be
Mhm.
questions 1 through 10, and so you're just going to whatever you get for number 1, put in number 1, whatever number 2, and whatever. And when everybody gets these in, we'll go over what the solutions are to them. So go ahead and pull mine out. But you should be getting them in your email shortly. And you guys cannot see what I'm doing. Apologize. Here we go. So this is what you should have in your email. And as you go through these, whatever one you answer, put it into the
Yeah, got it.
Yeah. Okay. Good. Yeah. So So this will be and when we come back. Let's say be back. What time is it? 3 o'clock. Okay. Let's see. Be back at 3:10. Yeah, and you can start looking at these and start going through them, and don't be afraid to make a mistake. And again, the CPA exam rules on it are pick the best one. So there might be more than one, but you're gonna pick the best one.
So are we back at 3:05 for the quiz, or should we take the quiz now? Is that what you said?
It's up to you. However you want to do it is fine with me. And then when they get put in there, we'll. There's 6 people, so whenever I get 6 of them of the polls answered, then we'll go over them. I'll give you guys the answer to them before you take them, and some of these will show up on the exam.
Okay, thank you.
Before we go to break, can you go back to H, the auditing standards board, please?
Give me 1 second. I gotta do the poll here. Yeah, this is under the AICPA, and they make.
Thank you.
You're welcome. You know, some of you are running late. If you missed the first part of class, these are for, I'm not sure what pages they are, but these are for the chapter 1 and 2 handout, the chapter 2 part. Or if you want to get a screenshot of that.
I submitted mine just now.
Okay. Take a look here. Okay, we're still waiting a couple. We'll leave it open for a little bit. Okay, I think we have everyone. Let me check and make sure. Yep. Okay, sharing results. Hopefully you guys can see them. So let's see here. All right, for this one, since we're tied at B and C, I'll take either one of those. C is correct. One second here. Okay, so C is correct. B is an unusual one. B's not a bad answer. It is possible you have management fraud that is found by independent auditors, and especially like for the financial statements. One of the weird things, though, is that most fraud is not detected by auditors. The people inside the company, whistleblowers, basically, are people more likely to find them. Other employees are more likely to find the fraud than the auditors are. Okay. Operational audit. Yep. Future improvements. You're trying to make things better. Financial audits, you're just trying to see what the finances were, and if it's, if they have inefficient operations, while that's unfortunate, it's not. Sarbanes-Oxley. Yep. A is correct. C, someone picked C there. C would be more of a compliance audit. That'd be if they're complying with the truth in lending laws. And D, we don't search for all illegalities. We're only looking for things that are material. So we only look for things that are material. If they encompass plan to actually search for all material illegalities, that would be correct. But we don't look for all. If they may have ones that are immaterial, we don't worry about. Okay, B, tax return. Yep. Are you complying with the audit? Governmental audit isn't a bad answer. The IRS is part of the government, but governmental auditing is generally considered for like audits of the federal government, like audits of the Pentagon, for defense spending and social programs and all that kind of stuff. That's usually what the governmental auditing is. Although the IRS is a government agency, so.
Professor, what was the answer for 2?
Future improvements.
Okay. Thank you.
Yeah, operational auditing. This is operational auditing is for effectiveness. Oops. And efficiency. Of an operation. So they're looking at, is it effective? Does it actually do what it's supposed to do? But also, is it efficient? And this is what we don't really, and we come to auditing, we look for if the controls are effective. If we only look at the controls, first of all, it's a narrow, only looking at the controls, not the whole operation. And we only look to see that they're effective. If they're inefficient, well, that's not great. It's also not, that's not the purpose of the audit. And this brings up an important point, though. When you're doing a financial audit, you are not there to improve your client's operations. Occasionally I get people to say, well, I'm trying to, we're trying to increase profitability. You can't do that. That's not your job as a financial auditor. Job as a financial auditor is to be unbiased and to use that you're unbiased to put out an audit report that people can rely on, that people can rely on the audit report to see the financial statements if they're, if they can be relied upon. So you do not try to improve their profitability. Go even a step further, that can also cause a point of that you would not be independent. For example, if you made a suggestion to the client and it didn't work out, you may be tempted to cook the books yourself to make it look like it was successful. So, you get into a real can of worms and talk about the best way to help the client is to stay independent and don't, try to help them improve their profitability and all that kind of stuff. There are people that help them do that, but it's not the auditors, consultants and stuff. Okay. Yep, B is correct for number 6. Yeah. And some people, are tempted to say, well, don't we call the police or something if we find you actually have a fiduciary duty to the client, and that fiduciary duty, if there's someone in their organization that's created a fraud, the client themselves can contact the authorities. That's not the auditor's job, and we have a fiduciary duty to the client, not to disclose confidential information. The lone exception to that is if you're doing an audit that includes government grants and stuff, government grants that require you to report any illegal activity if the government portion of the financial statement is included in the audit itself. But generally speaking, if it's not a specific program, you don't report. Okay, let's see, B. Primary responsibility for the financial disclosures the publicly held company rests with. D, management. Management is responsible for the financial statements.
Right.
Nine, what's the following types of services generally provided by CPA firm? Financial audits. B isn't a bad one. The operational audits are sort of like consulting. If they're not their auditors, they can definitely do those things. Sometimes if they're auditors, they can't. But operational audits, they can be done by CPA firms. But the financial audits, this is what the CPA license is all about. Kind of funny, operational audits are actually usually much more complex than financial audits because they look at everything. They look at financial reporting, they'll look at it, the operations are efficient, they'll look at their marketing plans and all that kind of stuff. But anyone can do those. But financial audits are only done by CPA firms. Who gets the CPA license? State Board of Accountancy. Mm-hmm. Well, you guys got 10 out of 10. You guys all get 5. Let me download this. Download the results. 330. What is this, week 3?
Yeah, I think I got 7 out of 10 right.
That's not bad at all. That's right in there for passing the CPA exam, to be honest. Man, I got a blank sheet somewhere. Okay. Yeah, the CPA exam, and here's the thing, the CPA exam, they tell you it's not percentages, but basically it's around 75%. Is passing the CPA exam. So 75% is perfect. So 7 out of 10, first time you've seen these, that's not bad at all. you know, if you study for the CPA exam, you know, the first time you get 7 out of 10, you retake that part, you get 9 out of 10, you take it again, you get 10 out of 10, you take it again, you get 10 out of 10, and then, you know, that's how you study for the exam. And again, you're looking, and you know, just know on the CPA exam too, remember that, you know, it's basically 75%. You can miss several questions on the CPA exam. So you run into a question that you have no idea what they're talking about, make a guess, go on. I mean, it's not, you know, you're going to find that on the CPA exam, and better to, you know, a question you have no chance of getting, you know, of figuring out, get rid of it, go to questions that you can figure out. So it's 75%. So 7 out of 10 for the first time you've seen this is not bad at all. I would say it's not unusual, is depending on what you're looking at, if you're studying for the CPA exam, like 50% first time through is not bad. People get disheartened because they're, I'm an A student, how come I missed half of them? It's a CPA exam, you know?
Yeah, I've taken auditing at Oakton.
Oh, yeah.
So some of the questions kind of remembered or kind of used my best judgment.
Yep.
So
Yep. And you know, another thing I can tell you about the CPA exam too, and studying for it and that, is eventually after you go through it a number of times, you kind of get used to kind of the format of them, you know. And by the way, the CPA exam, the questions are not available to the public, but they were up until 1996, which I know was a long time ago. However, there's a lot of stuff, especially like in this auditing, a lot of the stuff hasn't changed. You know, the sampling is the same. You know, the sampling hasn't changed. The point being, it was an open test up until 1996. We actually have all those questions that actually appeared on the CPA exam. So there are some, you know, these questions I just gave you. These are actually questions that showed up on the CPA exam. And again, even though they were whatever 30 years old or whatever, they're still relevant because these are actual CPA exam questions, and they do recycle questions for the CPA exam. If they get something they think is good, sometimes it appears in subsequent exams. Okay, let's go to classical sampling. I gave you number 2 as homework. And number 2 is somewhat similar to what you get on the CPA exam. They might just give you the totals and then they have you work out the average. But anyway, here's the average of you should have come up with. And then kind of getting used to just doing these based on the name of them. So if they ask you for the mean per unit, that means the average. And we talked about this before. Well, whose average do you take? Do you take the clients or the auditors? Well, the auditors, this is the one that is more persuasive. This is one that means more to you. You actually looked into it and came up that this is the average. You know, in legal terms, this down here is kind of hearsay. This is what the client gave you, said that they were worth, but you went and looked into it, and this is what you found they were. So you're going to take what the auditors. So this is the audit average. Okay. And you should have come up with the predicted value of 5,314,000. And the projected misstatement is 314, and this is understated. They're saying that they're saying that their book value is $5 million when it should be 5,314,000. So they're understating their book value. Okay, ratio estimation. Ratio estimation says if there are misstatements, they're off by a ratio. The large things, large errors, small things, small errors. And so we take this, and I think I rounded this. This is a rounded number. So the projected value is 5,160,000. Oh, whoa! What did I do here? Hold on. Okay. Down here too. I rounded off the nearest thousand. I guess that's not so bad, but anyway. So this would be the projected misstatement. Again, change that. If you took a screenshot earlier, maybe take another screenshot. Okay. Difference estimation, this is probably the most difficult one just because it starts out with the misstatement first. This is a misstatement. Oops. So it gives you the misstatement first. And again, you can look at the kind of, if the audit one is higher than the book average, this is going to be an understatement. If it's higher, you know, that they should actually, each one of these should have, spacing here. Each one of these is understated by $174. You know, this is what we say they should have. This is what they say. So everyone is misstated by 174 times 1,000 equals 174,000 understatement. And this is a plug number here. You know, how do we make, you know, we got 5 million plus the 174. So what would be the projected value? It's understated, so we have to add this into it. So this would be the projected value. So this is where it gets kind of confusing. So whatever, if the audit is higher, the audit average is higher, it's an understatement. And obviously, if it was lower, it'd be an overstatement. Question on that? Okay, I think we'll do one more together, and this one is a little bit. Take a look at it and see if this is what I'm thinking.
Would you be able to scroll back up to C and D real quick?
Mm-hmm.
Okay, thank you.
D, if you need that.
I'm all good now, thank you.
Okay, weird thing in the background here. What is that? All right. Let me see. This is one. Yeah, this is the one. This one's a little bit unusual. Let's go through this one. This one is actually a little bit quirky. It's gonna, so you guys just work on yourself. But here, we'll get the averages, and then we'll see what's quirky about it. Okay, we gotta divide these by 5. Yeah. Okay, so the audit average is what, 240? And this is the one that we think is most persuasive. 240. That's when we looked into ourselves and we calculated that number, so we have more confidence in our number than we do in the client's number. You got these all on one page? All right. It's probably going to be tight. So see if you can do the mean per unit one. I'm going to move this down here. Again, I think a good way to remember these is just look at, actually read what it says. Mean per unit is just average per unit. Who's average? The audit's average, the one that we believe in the most. Oops. Hey, it should be $1. I'm not already generous with the room here. I'm gonna Okay, so this would be this is higher. So this is understated. There's something unusual about it. So see if you guys can figure out what these are. There's something unusual about them.
We have different answers.
Yeah, if you look at this first one, move here for a second. Ah, that one's a different font. This is a different size font. Okay, yeah, so this is so they're saying that their book value is 2,500,000. We're saying it's 2,400,000. So this misstatement, are these books overstated or understated? Is the book value overstated or understated? We're saying it's worth 2,400. They're saying it's worth 25. That's me. They're saying it's worth.
It's overstated.
Yes,
They
exactly.
overstated the value.
Exactly. They overstated this. I'm glad you jumped in there. I was groaning. All right. Yeah, so this is
So overstating comes from, is overstating or understating intentional?
it depends. It depends if it might be intentional, it may not be. And it depends on the degree of it, whether it's material or not. But and you do have to be a little careful that it's almost impossible to do an audit without finding something. Just from mistakes, people that, oh wait, what was the tax supposed to be? It's supposed to be, oh, okay, you do get that, but if it is intentional, obviously it puts it in a different category. If it's material, oftentimes it is intentional, but it really is a judgment call. And when you're doing these kind of problems for the CPA exam, they generally don't ask you whether it's material or if it's fraud or error or whatever. They'll just say, what would be the projected misstatement for this using the mean per unit. And they give you a few multiple choice questions, and one of them would hopefully be projected misstatement is 100,000 overstated.
Yeah. So I guess the amount of misstatement can also determine if it's intentional or not.
Yeah, a lot of in
right.
Yeah, I think we talked about this before, and maybe it didn't, but oftentimes, if the financial statements are materially misstated, it's at least a pretty good likelihood that it's intentional. The reason being, misstatements are often, if there's a material misstatement that happens by accident, a lot of times the client will catch it themselves because they have controls to do it. If it's not caught, usually it's intentionally not caught. And that makes the audit a much more difficult audit, because now it's harder than simply an unintentional error. Unintentional errors are oftentimes caught, whereas if it's a and a lot of times you get into people who are just trying to be aggressive with the numbers and book something as a sale. It's not really a sale and that kind of thing. But if they're, it is a fairly good possibility, if they're materially misstated, that it is fraud. And fraud is more difficult to find because you have somebody actively trying to conceal it. Oh, actually, that brings up a kind of a funny point. For the CPA exam, they say type 1 fraud is financial statement fraud. Type 2 fraud is employee theft. Legally, theft and fraud are two different things. Theft is you just grab something and stick it in your pocket, whereas usually fraud has some sort of deception. That there's some sort of deception that you use to keep from being discovered. There's usually a second, it's not just taking the money, it's taking the money and usually trying to cover that. So, it's a fine point, but fraud, ACCT330 says, hey, theft is the same thing as fraud, and but yeah, legally there actually is a difference between them. Okay. So this next one is a little bit unusual, and it is, I'm going to mess this one up. 227. 27. Too many sevens and twos there. All right, so this one, I'll use this. The projected value is this. The projected misstatement is this. And for this one, is it overstated or understated? The book's overstated or under?
Understated?
Right, yeah, exactly. So this one is a little bit weird in that, a little bit odd in that, they will give you different numbers. If they didn't give you different numbers, there'd be no reason to have two different methods that give you the same number, obviously. But they give you different numbers, but it is possible that they'll even give you whether they're understated or overstated. And the mean per unit is kind of a wacky one compared to the other two. They're all different in their own ways, but this one is different in that it doesn't matter what, it doesn't take into account the book value, the average book value at all. It's just what is the audit average. And between C, D, and E, this is the one that can actually be used for things way beyond auditing. You could use this to find out what the what the average weight of a duck is on a pond. You go out and you pick up some ducks and you weigh them, and you mean per unit, you can figure out, okay, the average duck weighs so much, so if I have 10 ducks, this is, you could do that. The mean per unit one, because there is no, you're not handed a paper that says, okay, this is the average duck weight. You're simply going out there and taking your sample to figure it out. Okay, this one down here is the most tricky one. And that is, we have this misstatement. These are going to be understated by 200,000. Oops. And again, so on this one, notice that we're saying that every one of these is understated by $20. Here's the audit average, here's the book average. Every single one of these is understated by 20. So you're going to take this $20 and multiply it by every single item. So you'll get every single item is off by $20. So multiply by 10,000 items. This is what the misstatement is. And these will be understated. So what would the projected value be?
It's just 2.3 million, right?
Actually, 2.7.
Oh my bad.
No. This one's a hard one. This is because you're getting the misstatement first. If these are going to be overstated, so it's going to have to be higher than the book value. I mean, I'm sorry. If it's understated, it'll be understated by the 200,000. I said that wrong. See, I'm getting confused. So our estimate will be $200,000 higher than the book value. Okay. You know what? Let's stop here. I might just assign this as well. I'm going to send out the exam for I'm just going to send out the exam for chapter 1 and 2. Just stop here, and I'll assign this probably as homework at some point. If you want to go ahead and work through these, that's fine. But I'm going to send out the nope, not that. I'm going to send this out in the email probably in like the next hour or so. I'll send out an email with chapter 1 and 2 exam. It'll be due a week from Friday. So you have like 9 days to do it. Yeah, today's the 31st, so actually it's 10 days. I don't know, whatever it is, do it on the 9th. Let's leave it at that. Okay. Yeah, so we'll call this a class then. Any questions? And there is let me check and make sure actually. Not that. I think I have it in here. No, I don't. Okay, well here, you guys get to watch me put in an assignment. We're going to do handout. It's actually not due on that day. It'll be due on the 9th, and this will be the exam. Make it in red. It'll be emailed to you, so do not look for it in Blackboard. It'll be in your email. And submission. This is unlimited attempts, last graded, highest grade. Okay, so here's the deal about the submitting the exam. For every other thing that we do, for instance, today you can submit the chapter 1 and 2 handout in here. And I think we talked about this, but we scratch that. How do you submit it? Not like that. Hold on. I'll take any way you can submit it. Basically, you complete the document like I do, right into the document itself. If you do it on separate, you can print it out and scan it. You can also do it on notebook paper. So there's nothing wrong with doing it on notebook paper. And you can either scan it or take pictures of it. So you can take pictures of, whatever you did. If it's in a notebook, fine, just take pictures in the notebook and submit those. Do not put them into zip files if you're in Windows, or page files if you're in Apple. Blackboard doesn't like them. So if you have 10 pictures, just upload 10 pictures. And these will all have unlimited these are all unlimited attempts. So you can put as many, 10 pictures, it'll take 10 pictures, but do not put them in a zip file. I know that it's more convenient to put it in zip and page files, but Blackboard doesn't like it. Okay, so this will be the exam. Now, when it comes to submitting items, it's unlimited submittals. So if you submit the wrong thing, let's say you submit the chapter 1 and 2 handout, you realize you submitted the wrong thing, or you submitted a blank one, or you submitted a picture of your cat or something, you don't have to contact me. Just resubmit it, the correct one. Okay, and if there's 2 submittals, 3 submittals, whatever, I always go to the last one. I figure the last one is the one you really want me to look at. I go to the last one. If that one doesn't work, then I might go back and through the other ones. But I generally go to the last one that you sent in. So don't worry. You don't have to call, text me and say, oh, I submitted the wrong thing. Just submit the right thing. And those can be submitted and resubmitted at any time through the entire semester. So if you submit one that wasn't complete or something, and you didn't get all the points, you can resubmit it and get the points. So you can always resubmit the homework and the textbook problems that we do. Exams, once you submit the exams, you can resubmit them up until I grade them, and I usually hold off grading them until I get to the due date. So if you take an exam, you turn it in, you realize you did something wrong, fine. As long as I didn't put a grade by it, you can resubmit it. I'll take the last one you submitted and assume that's the one you want. So exams can be resubmitted, but only up until they're graded. Once they're graded, then they're just graded. But you can resubmit exams up until I actually look at them and put a grade on it. So again, if you submit an exam and you realize you did something wrong, or you submitted the wrong thing or whatever, not a big deal. Just submit the right one. I go to the last one that's submitted. All right, so I'm going to send out the exams. The exams are all going to be emailed. The reason they're emailed, there's different forms for different people. Make sure you do the form that I sent you. But the exams are similar to what we have, and the questions will be similar to what we have in the handouts generally. So anyway, and some of the multiple choice questions will appear on there, if not in the exact format, in a pretty similar format to what we have on the thing we just did. Any questions?
No.
No. Okay, that's enough. All right. Well, I will. So anyway, probably in like the next couple hours, I will send you an email that will have the exams in, and again, you can start submitting stuff. We finished up the chapter. We finished up the chapter 1 and 2 handout, so you guys can submit that. We didn't finish the classical sampling. If you want to finish and send in, that's fine too. But I want to go over a little bit more of that in class next time. And then the exam that I'm sending out, when you finish it, you can enter it here. And so this does not have. This will be emailed. Let me put that in there. So as I'm thinking about this stuff. And again, the reason it's emailed is that you'll have different versions that will be out there. Okay. You guys had enough? I think I have. All right. I'll talk to you guys in a week, and the exam should be probably in the next couple hours. You should get the exam. Okay. All right. I'll see you guys.
Bye.
Thanks, Professor. Bye.
Says.